Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, so the first question I have today is from Audrey, and Audrey sent this question back in August 24, and for some reason my assistant Ivy and I must have missed it, so I apologise for that. And if it does happen to anyone, of course, just let us know. I will respond to every question that I get, even if it's a response like I've answered it previously, have a look at this blog, or I can't answer it, whatever it might be. And I think that's important, by the way, because I'm not sort of cherry picking the questions or, avoiding any more answering difficult questions. Anyway, let me read out Audrey's question. Audrey writes, I'm just wanting to know the best use of excess cash. I'm 49, single, and have no dependents. I have my own home and 3 investment properties, one of which is owned in a self-managed super fund. I currently have a mortgage on my primary place of residence, so non-tax deductible debt, and have funds sitting in offset, which is fully offsetting that loan. So effectively, my home loan is fully repaid. I have set up another offset, which is against one of my investment properties. I'm able to save between $2,000 to $3,000 a month, and it's currently going into the offset linked to my investment loan. However, am I better off putting the excess funds into my self-managed super fund loan account, given the interest rate on the self-managed super fund is higher than the investment loan, and the interest charges on my self-managed super fund are not tax deductible? I'm hoping this question is able to be answered, given I want to engage the services of Pro Solution, although I got rejected. However, I understand the reasons behind I got rejected. Okay, sorry, Audrey. Sorry, obviously, if there's not a lot of scope to add value, if you're in the phase of you've acquired a bunch of assets and you're really focusing on debt reduction, I would argue you probably don't need an advisor, and that is the scope for us to add value is pretty limited. So let's go back to your question then. The first thing I would say is that the interest in the self-managed super fund should be tax deductible. In fact, it almost certainly will be tax deductible. I guess there's 2 things to look at when we're thinking about which loans to offset and the best use of cash flow. The first thing is to look at the interest rate, of course. Of course, it makes sense to offset, firstly, non-tax deductible debt before tax deductible debt, although in Audrey's situation, she's fully offset her home loans. That's fine. The next question then is to offset the loan with the highest interest rate versus, leave the loans with lower interest rates not offset. Although you then need to think about the tax effect or the after-tax cost of debt. So, for example, I don't know Audrey's income level, but for example, if, you're paying 6% for an investment loan that's, say, in your personal name, and you're on the highest marginal tax rate, which is 47%, your after-tax rate is going to be just over 3%. Whereas if you're paying, let's say, 8% in a self-managed super fund, a self-managed super fund has a flat tax rate of 15%. So an 8% interest rate less a 15% tax deduction gives you an after-tax cost of debt of 6.8%, so more than double that of the rate that's outside super. So based on that analysis alone, yes, Audrey, you would be much, much, much better off, more than twice as better off offsetting the loan in the self-managed super fund. However, there's one significant caveat here, and this is a good example of why just focusing on, the numbers or the tax impact or the saving over the next 1 to 2 years, in the short-term saving, let's put it that way, might give rise to an actual mistake. Because what I'd really like to know, Audrey, is what is your strategy? Because one of the downsides with repaying the loan in the self-managed super fund is that you reduce the amount of liquidity in your self-managed super fund. And if you don't have enough liquid assets to be able to pay a pension when you move into pension phase, whenever that might be, which could be in 11 years' time, you might actually be forced to have to sell that asset to create that liquidity, even though you don't necessarily want to sell it. Maybe it's a great asset that's performing really well, or you want to keep it for another decade or whatever it might be, and you prefer not to sell it, but you kind of have to because now you've got to meet the minimum pension repayments. So having a property inside super offers some good benefits, although I think, and I'm going to explore in a blog and episode next year that I think we can achieve similar-ish benefits for some clients outside of super in terms of minimising capital gains tax, because that's one of the big attractions to putting property inside a self-managed super fund. But one of the things we need to think about is how much liquidity do we have in the fund? And we want, hopefully, the property asset to not be all of the assets. It's always going to probably be a substantial asset, but we want to build that liquidity outside of super. So, in fact, depending on your situation and the other assets you may or may not have inside super, you might actually be better off putting it in the offset account in the super fund. Obviously, that's going to save you more non-tax deductible debt. But whether you actually then invest some of that surplus cash flow in other assets like equities, or just leave it in the offset account that offsets hopefully you've got an offset in your self-managed super fund loan, attached to your self-managed super fund loan. But essentially you want to think about liquidity and those sorts of things. And so you might actually be better off doing something else. But as a general rule, putting in the self-managed super fund considerations aside, it's really just comparing the after-tax cost of debt to find out which offset account you really want to put those monies in. Anyway, I hope that answers your question, Audrey, at least to some degree, and sorry that we missed it and it's taken me many months to get back to you. Okay, next question is from Nick. Nick says, we are age 53 and 51 and self-employed. We have a commercial building owned by our self-managed super fund, which we operate our business from, worth 1.3. We obviously pay ourselves some rent, pay the rent into the self-managed super fund, which is less than the repayments. So I think what that's suggesting, the building's negatively geared. Nick and his partner also maximise super contributions, so $30,000 each. They have an additional $130,000 outside of the self-managed super fund with Q Super. We're looking at rolling it all together and buying investment property in the self-managed super fund. I believe we can prepay the rent through to June, which would give us an additional amount of money in the self-managed super funds. The fact that we have no exposure to shares or bonds at all is at loggerheads. One vote for property and one vote for shares. I guess Nick and his partner have different ideas there. There's also $200,000 in Bitcoin that we're not looking to sell anytime soon. In the last 8 months, we've maxed out our borrowing capacity to now have 3 investment properties negatively geared, also a mortgage against our home. I've never had any investment properties, but now have 3. Here's the question. There's a question in there somewhere. We don't have an advisor at the moment. If we go into shares, it's pretty much set and forget, and we can keep dripping in around $4,000 a month. An investment property would have a loan attached, and not sure if the interest paid over the life of the loan would be worth it over an investment in shares and cash and no repayments. Long question, possibly not suitable, happy to discuss. Okay, so Nick, well, if you've got already a lot of gearing and you've got a lot of exposure into property, my first view would be, well, why would you want more? I mean, if you've got 3 investment properties outside of super, you've got your family home, which still has some debt against it, and you've got a commercial property inside super, that sounds to me like a lot of exposure to property. If all those properties are really good quality assets, they'll do their thing over the next 2 or 3 decades and probably result in you building more wealth than potentially you'll need in the future. So you're well on your road to doing that. It always makes me a little bit concerned, I should say, just as a bit of a side note, when I learn a client's gone from 0 investment properties to 3 investment properties in 8 months. That feels like, just doesn't feel considered and necessarily appropriate. And I always sort of shudder to think, have we made some right decisions here? Do we have geographical diversification? Have we really thought out the ownership structure, all those sorts of things? I mean, it doesn't necessarily mean it's been a bad thing to do, but it's something that I'm conscious of. Something I'll be writing a little bit more about next year as well, about getting caught up in some of this property hype that occurs. And I'm not negative against investing in property, of course, as long as we're doing it well. So, Nick, I would have a strong vote for no investment property in your super fund. And I just answered Audrey's question previously, and I talked about liquidity inside super. You're in your early to mid 50s. It's not appropriate then to add more liquid assets inside your super. Host Plus, which is obviously industry super fund, actually allows self-managed super funds to hold an account within Host Plus. So that what you can do then, it means that your self-managed super fund can own an account in Host Plus, and then you can go and invest it in growth or balanced or whatever the pre-mixed investment option is that is most appropriate for your circumstances. And the reason I mention that is because it's kind of nice and tidy, because you can have an investment property in a self-managed super fund, but then you've also got a really simple, low-cost, easy way, relatively low cost. Host Plus's investment fees are relatively high. Its returns have been good, but it's on the higher end of the scale. But anyway, it's a relatively easy way to go in terms of having a portfolio that's invested in the market that's professionally managed from an asset allocation perspective. Similarly, you could still invest it in a diversified ETF, which I've spoken about many times. But Nick, I would strongly advise you going and investing in more property. You already have enough gearing. Liquidity is really important in super, and so I think having that balance is really a great idea. Okay, next question is from Sally. Hopefully I've pronounced that name correctly. Sally provides a lot of very pleasant and kind feedback about the podcast. Anyway, I'll read out the question. I'd like to ask if you could please do an episode on insurance, life, TPD, income protection, etc. It's suddenly one of the major expenses in our household. We often wonder if it's worth it to have it over the years. Over the years, we've consulted advisors regarding this, but unfortunately, they've got us into different products which we really think are not the best option for us and definitely not good value for money. Could you please dive deep into this topic and explain what insurances are important to have, how to calculate how much insurance we need, and suggest the good companies and products if possible, please. We're a family in our 50s with one adolescent son. Thank you very much. Okay, so thanks for the question. Episode 328, I talked about smart strategies for managing the cost of insurance. I primarily talked about income protection insurances, but I think I will do some more episodes on insurances, particularly working out kind of how much insurance you need. Although if you go onto our website and just search, the search function on the blog page is actually quite good, I should say. And it will find the blogs that I've spoken about previously about insurances and how to manage the cost and those sorts of things. I mean, some general observations with respect to risk insurances like life, TPD and income protection and trauma insurance is that the insurance companies are pretty cagey in that they regularly change their products and the characteristics and the coverage of those products to really build on loss aversion. And this is not only just true with with these sorts of personal risk protection insurances, but even for health insurance and so forth. I've noticed they do the same thing. So every time you call up or you consider changing your insurance, they say, "Oh, this product's no longer available." And so, think carefully about cancelling or changing it. And they use that loss aversion to try and keep you in that product. So if you're in the wrong product, of course, don't try not to be influenced too much by that loss aversion. Having said that, to switch out and get replacement cover, particularly in your 50s, can be really challenging. All of us, when we get to that sort of age and stage of life, have probably suffered some health issues that insurers are probably going to find something to exclude or add a loading, but we just find that later in life it can become quite challenging to get replacement cover. In terms of providing sort of companies and product recommendations, I certainly can't do that. It really depends on a whole bunch of different things. There's no one size fits all. But I think it's just about finding an advisor that's going to give you some good advice. It's one of those insurances, one of those things that feels costly and feels like a waste of money, but we need to sort of protect ourselves and we need to do the right thing, obviously, to protect our loved ones. The other thing I would say is that I find, if I meet a client in their, say, 40s and they've never had insurance, but I think they really need it, say they've got young kids, they're a sole income earner, etc., really difficult to convince them to take up insurance at that point in life. And similarly, if I meet some people, say in their early 50s, and I feel like they've got way too much insurance, but they've had it for a long time, it's equally difficult to convince them to reduce it. So it's funny, the psychology around insurance, we kind of tell ourselves a story about it. Just be cognizant that you are telling yourself a story about insurance cover. So I didn't really answer any of your questions there, but I will keep talking about insurances as a topic on this podcast. Okay, next question is from Mark. Mark writes, I love the Q&A sessions, a lot of interesting situations and lessons to learn. Mark, I should have done this Q&A thing years ago. I'm just as interested as you are, so agree there. Mark writes, with respect to debt recycling, you have been a bit disparaging about the strategy, but I think it has been a bit of a straw man argument based on the goal of repaying the mortgage more quickly, whereas I don't think it's necessarily what most people are focusing on. Surely in the situation where one, you have a mortgage, and two, you have decided to invest outside of super, then it's a no-brainer to debt recycle in most circumstances. The debt level would be identical if you debt recycle or don't, but now some of all the debt is now tax deductible. The more general question of whether to prioritize investing or paying off your mortgage is different, and the debt recycling at the end of the day is just a tax strategy. So thanks for your question, Mark. Look, I think the thing, and it might sound like I'm sort of splitting hairs, but it's really important to me that people understand or aren't sold a story, okay, and really understand how things work. And debt recycling, and this is why I've spoken about it in this way, debt recycling online and in different places over the last 20 years has been pitched an idea that's going to help you repay your home loan sooner. And I just wanted to be really clear in this podcast, it's not going to do that, right? It doesn't really do that. If you've got an extra $3,000 a month and you decide, well, I can put it into my home loan and repay it at a much faster rate, or I could put that $3,000 into the share market. And what you're saying, Mark, is, well, why don't you put it into the home loan and then go and borrow the 3,000 and put that in the share market? That's just an allocation of capital decision. It's not really, I don't really regard that as debt recycling per se. And there's debt recycling strategies that are truly debt recycling that we might use for Medico clients, or where there's some tax guidance around it. I'm not going to talk about them in this podcast, because if I talk about them in this podcast, the ATO can accuse me of running a tax scheme, which of course I'm not. And so, the law is against us being able to openly talk about, the different strategies that clients use, although we have touched on them previously in a topic in an episode in the Holistic Accountant podcast. So that's why I've been careful about that. So I don't really regard it as debt recycling, or at least let me put it this way, debt recycling tends to be used online as a description of somehow reducing your home loan at a much faster rate. But as a general strategy, if you have a home loan and you have surplus cash flow and you want to start investing in shares outside of super, then yes, for most people, probably almost all people, it would make sense to put all that surplus cash flow into your home loan and repay that at a much faster rate, and then borrow the contributions that you're going to make into the share market. And so have that fully geared in return for reducing your non-tax deductible debt. But to my mind, that's just a capital allocation question. It's not really debt recycling, or at least I wouldn't want to label it as debt recycling, because I wouldn't want it to get mixed up in all the other stuff that's online that's sort of promoting. And there used to be a lot of it. There's less today, but I remember MLC used to have a product brochure that sort of espoused the benefit of borrowing to invest in shares, and it somehow helps you repay your home loan sooner. And I guess that's coming from that perspective, Mark, and that experience. That's all I seek to do in this podcast, is just make sure really clear that we're not using any labels that are intimating or suggesting that the strategy is going to do something that it's not going to really do. And remember, the people that have been writing about these things are selling a product, right? They're trying to get people to start investing or buying managed funds and those sorts of things. So there's always been kind of a product at the back end of it rather than a strategy question. So I'm sorry if you feel like I've been really negative about debt recycling. To me, that's just a cash flow allocation or capital allocation decision. Okay, next question is from Joan. Joan writes, I have over $1 million in super and I'm paying almost $19,000 a year in fees, including financial advisor fees of $6,500 a year. I'm retired and age 66. I draw $70,000 a year and I'm single. They invest for me and I see them once a year. They have 2 buckets for me, taxable and non-taxable, which I'd like to keep going. Industry super would cost approximately $11,000 a year in fees or less. I want to transfer to an industry super fund to save on fees. What do you think? That's a great question, Joan. And this is one of the things that we have to tackle with in our business when we meet new prospective clients is, where is the scope to add value and considering that. And if we were looking after a portfolio of $1 million, and let's say we were going to charge $6,500 a year to do that, which I don't think we would, but let's say we would. Would I think, put it this way, and this is what we always ask ourselves. If you were my family member and you said, Stuart, I've got $1 million in super, should I pay someone $6,500? And that's all they're going to do. I don't have any other needs in terms of advice needs beyond that. I reckon I would say no. I reckon I would say it's not worth paying $6,500 a year for that. Now, if a client had $1 million in super and they had a bunch of other assets and a lot of changes in their life or expected change in their life, and there was a broader scope to add value, then I think, and super was only one of those things that they were going to work on, then it might make sense. But if it's just super alone, it doesn't make a whole lot of sense. That you're always going to have a taxable and non-taxable portion in your super. That doesn't change depending on whether you've got advice, and there's not much other than a recontribution strategy. There's not much you can do to sort of change the taxable and non-taxable portion. So I wouldn't worry about that too much. I think minimizing fees and maximizing returns is a good idea. So I guess the only thing you want to think about then is if I'm paying $6,500, what am I getting in return over and above what I would get at an industry super fund? So therefore, look at the historic returns that you've earned on your super, and unless they're absolutely shooting the lights out, if they're not materially better than an industry fund as an alternative, then Joan, I reckon you should probably switch. And people like you should probably switch and move to a lower cost arrangement because it'll save you $8,000 a year, which is a pretty sizable saving given you're drawing a pension of $70,000 a year, right? So, it will have a significant compounding impact, I would say, on your situation. But, again, if they've delivered ridiculously high returns over a very long period of time, you think they'll continue to do that, then of course it's worth paying $6,500 in fees. But okay, so I hope that answers your question. Of course, Joan, that's not specific advice. I don't know all your circumstances. I don't know if you've got any insurances or those sorts of things. I doubt it if you're retired, but at least just based on what you've told me, that's what I would be thinking about. Okay, next question is from Kobe. Kobe references the 2-part series I did on different super options where I talked about industry funds, retail funds, self-managed super, wrap platforms, and so forth. Kobe asks, the one point I'd like to ask clarification on is the future, in a future podcast potentially, is regarding the capital gains tax of the different vehicles. And then Kobe goes on to sort of explain that they have a Vanguard super account, and how does all that capital gains tax situation work? Well, Kobe, I answered a question about capital gains tax and super in last week's episode on the 7th of January 2025, where I actually went to the effort of putting a sort of projection or an estimate of what that capital gains tax saving could be. As a general rule, let's try and keep it really simple for you. The only way you're going to avoid the capital gains tax is if you're in a product that treats the tax at the investor level, not at the fund level. Okay, and that product's going to have to be a wrap style product. And I think Vanguard Super, by the way, acts as a sort of wrap style product. And I talked about this last week on the 7th. So just reference that conversation again. I'm not 100%, so I'm going to confirm that. But in a wrap style product or a self-managed super fund product, because that means tax is dealt with at the member level or the account level rather than the fund level. If it's a pooled super product with a daily unit price, they have to deal with the tax at a fund level. And that means that they will calculate the tax liabilities at the end of each day and net that off or take that into account when they strike a daily unit price. And there's no way to kind of get around it other than to have, a wrap or a self-managed super fund style product. Um, Also, changing a product or switching to a new super fund that has a different trustee is a capital gains tax event. So, for example, if you had super in a wrap product and then decided to start your own self-managed super fund, and then you rolled the money over into that self-managed super fund, even though those two products are tax is dealt with at a member level, because you're essentially changing the ownership because you're changing the trustee, that's a capital gains tax event. So to avoid capital gains tax or minimize it at least, you kind of have to pick a ownership structure like a self-managed super fund, stay in that self-managed super fund for most of your working life, transition then into retirement or convert that your account into pension phase, and then presto, you've eliminated any capital gains tax. Anyway, have a look or listen to last week's episode where I talked about it in a little bit more detail, and something that I will address in my annual blog, which I prepare at the end of July, early August, when I compare and look at the best industry funds, best super funds, I should say now, because I'm going to include Vanguard in that analysis in a few months' time. Okay, next question is from Miles. Miles got a really interesting question. I have the below question for the podcast, which I think would be relevant to many in the current climate. My wife and I have an investment property in Brisbane worth $900,000 with $600,000 of debt. We are considering selling this investment property, which would allow us to clear our primary place of residence debt entirely, free up borrowing capacity for a better blue chip investment property. With the current borrowing capacity limits, we think this is a win-win on both fronts, but have a voice in the back of our head saying never sell. What are your thoughts on selling investment property, clear primary place of residence debt, and freeing up capacity to hold a better quality asset? Well, Miles, my general view is there's never a bad time to buy a great asset and never really a bad time to sell an underperforming asset. Quality is really key. If you've got about $300,000 of equity in that property, I'm going to assume your home loan, relatively speaking, is relatively low. So I would consider selling down an investment property or investment property portfolio where I had a substantial non-tax deductible debt, and I wanted to really crystallize that capital and reduce my non-tax deductible debt exposure. But in your situation, it doesn't look like that. I mean, if your home loan's $300,000, that's not a small sum of money, of course, but in the scheme of things, relative to home loans these days, it seems pretty manageable. Although I don't know your age and stage of life, but let's assume you've got a little bit of working life left. And that is, in fact, a manageable level of debt. The other thing I would then think about is, okay, you've got this property in Brisbane. It's not perfect, or you're suggesting it's not a perfect asset. But in a rising tide, all ships rise, which I know contradicts a lot of what I say in this podcast, which is all about quality. But it is true, in a rising tide, all ships rise. So, and I think, the Brisbane market has a little bit of steam left in it. So one of my concerns would be, if we go and sell this asset, what else do we buy? We've got the transactional costs associated with it. Are we going to be better off? Or should we just ride out this growth cycle, hold that asset for another, let's say, 4 years and then buy into a different market like Melbourne, for instance, again, depending on your budget and borrowing capacity, that might represent better value. So I guess that's the thing, and that's difficult to draw a conclusion on because I don't know what the asset looks like, as in how bad is that asset. You really want it to be a bit of a dud, like a lot of a dud, for you to have the confidence to necessarily sell it today and pay all those costs. If it's just a case of, oh, look, if I had my time again, I wouldn't buy it because it has a couple of negative attributes, well, that might not really be enough to make that change. I did some work many years ago and concluded relative to the transactional costs, you got selling costs, potential capital gains. I mean, even if you haven't made a huge gain here, if you've claimed depreciation, that reduces the cost base. So capital gains tax, and then you've got to buy in, so stamp duty and maybe buyer's agent fees. It's not a costless exercise. And then you've got the risk of actually replacing an asset with a better performing asset. And I mean, that's doable, but of course it's not guaranteed. So there's an element of risk there. And so I concluded maybe I should update this episode or this blog because I wrote it many years ago. I concluded that you need to be about 2%. There needs to be about a 2% differential. So that is that your dud asset is growing at 2% or more below a investment grade asset. Which means that it's got to be a real dud. If it's just got some impairments with the asset, it's not perfect asset, and it's growing at say 1% less, based on that analysis I did many years ago, it's probably not enough to necessarily sell and replace the asset. So what should you do? Well, I think just having a look at relative performance of the asset might help you sort of paint that picture. So I would look at, since 2018 is really when the Brisbane market started to move. So I would have a look at how have assets that you would regard as good quality investment grade assets, how have they performed relative in terms of percentage capital growth wise, and how has your asset performed over the same period of time, and just try and find some data points there that might help you understand what is the relative underperformance. And certainly, there was a flat cycle before 18, so you're probably not going to get a lot of usable data before that. And I would try and build more evidence around the decision of whether you should sell. Just as a general rule, selling's a bad idea. So I would say that, I mean, that's true with most assets. Prices tend to trend higher over time. And so we want to be really careful. We're always really careful about giving clients advice to sell an asset, unless it's an absolute dud, right? So if this asset has very little positive attributes, then of course, you're better off selling. But I'm always cautious, around this sort of decision. And I would look for more evidence around the relative performance. And I'm going to put that on my list to do a podcast next year and answer the question, how bad does a property need to be to warrant selling it? Okay, that's me out of time, I guess. If you have any questions, or feedback, please send them to me at questions@investopoly.com.au, and please share the podcast. Please leave a rating wherever you're listening to it. That would be greatly appreciated. And until tomorrow, bye for now.